Okay, well, we will get started. It is we have a full, all members of the committee are present. We have a quorum, and it is 9 o'clock. So, good morning. My name is John Von Paris, and I am serving as the chairman for the MDTA Finance Committee meeting this morning. I hereby call the meeting of the Finance Committee to order at 9 a.m. Due to the COVID-19 pandemic and in accordance with the live streaming law, this meeting is being conducted via video conference and being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public, no elected officials, and no members of the media pre-registered to speak at today's meeting. At this time, we will move on to agenda number 1, the approval of the minutes from January 12th, 2021. Has everyone had time to read the minutes? Are there any corrections? If not, is there a motion to approve?
So moved.
A motion from member Rosen, a second from member Carroll. Any further discussion? All those in favor?
Aye.
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 Okay, the minutes are approved unanimously. Thank you. We will move on, and incidentally, this is the minutes for the only approval item, as you know, on the agenda today. We have 4 updates, important updates, I may add. In the first one, item number 2, the investment committee report. I have Alan Garman and Clayton Viwig here for their presentation. Good morning, Alan.
Good morning. This is our normally scheduled quarterly update on investment performance and activity. We'll touch a little bit on the economy, fiscal policy, and monetary policy, and how that may affect our portfolio returns going forward. If you turn to slide 2, I'll turn it over to Clayton to cover these first few slides.
Thank you, Alan. Good morning, committee. Happy to be here. If everyone can hear me fine, please, or cannot, please let me know, and we'll try to change things. What we see on slide 2, as Alan has mentioned, is a chart on the top left that indicates an uptick in rates, especially at the 10-year point of the curve. This came about as a result of clarity on the election, as well as improvements in the prospects for vaccine related to the pandemic. Over on the right, top right chart, you'll see that the 2-year rate, though, has been fairly stable since the beginning of last year. Unemployment continues to improve during the 4th quarter, dropping from a peak of 14.8%. And in addition, one of the things we look at quite often is the capacity utilization, which indicates how much of the infrastructure is being used to keep the economic engine moving forward. Slide 3. I guess it's most important to highlight the Fed's perspective here on the economy. They've gotten a little bit softer as it relates to improvements in the economy and have kept the federal funds rate consistently between 0 and 0.25%. Anything to add there, Alan?
No, I think that covers it.
Moving on to slide 4, we can see the portfolio exposure, the portfolio activity, and the asset allocation in dollars and percentages there at the bottom. We've had a few maturities in the treasury space and the supranationals remain significantly weighted to agencies and also have an allocation to commercial paper. We're continuing to look at the commercial paper space. I think there are some opportunities there, and so going forward, you may see that allocation increase a bit. Moving on to slide 5, I will turn it over to Alan.
Great, thank you. The strategy slide, at the top, you'll see 2 tables. It shows our strategy for the prior quarter that ended in December and the strategy for the upcoming quarter. For the general account, which is the largest account, approximately 300 million, there's no change in strategy. For several years, we've been using a 1 to 5 year agency benchmark, and that's approximately how the portfolio is structured. So there's no change there. The benchmark duration is approximately 3. For the M&O reserve, if you recall, the board approved a duration extension back in February, and then we were hit with the pandemic and record low interest rates. And so rather than extending the duration of that portfolio, in the midst of all-time low interest rates, we put that on hold for a period of time. And we came back to the board with updates periodically and finally started that duration extension in December. And prior to that, we had indicated that the extension would probably be relatively slow, and we were looking for opportunities in taxable municipals to pick up a little additional yield, and potentially they may be a more defensive because supply demand issues in that market currently. So that's where we are with the M&O reserve. The prior benchmark was the same as the general account, essentially 1 to 5 year agencies, and the new benchmark is 1 to 13 year treasury strips. So the duration of the new benchmark is 7, and we're just tiptoeing toward that with a couple of new investments in December and January. With the other accounts, they're primarily match funded. So the capital account receives excess operating revenues, and then those monies sit there until we use them for capital spending. So there'll never be any strategy change for that account. Debt service reserves. We issued bonds last year, and at the time we were unable to purchase a surety policy. So we had to cash fund that debt service reserve. That was for our 2020 bonds. That was about $30 million. So our prior strategy for debt service reserves was a slightly longer index than the 1 to 5 year index. We were using a 3 to 5 year index. But we had a couple of considerations in that account. And one is that we're still trying to obtain a surety policy, and we're pursuing that for this upcoming bond issue next month. At the same time, the possibility that we'll be able to buy a surety for debt service reserve. And in that case, we'll be able to release that $30 million from the reserve into the capital, our construction account for projects. So rather than investing the money out longer and then having to sell those investments potentially at a loss, we've been holding that portfolio very short with the expectation that we may buy a surety policy. Then moving on to slide 6, I think a couple of important points here is the table at the top shows investment returns historically for our main index, which is the 1 to 5 year index. That's the index for the general account. And what's noteworthy is the top line is the income return, which is essentially the weighted average coupon of all the securities in that index. And then the next line down is the price return. So anywhere you see negative numbers that are red, that's a year when interest rates were rising and prices were falling for bonds. And so that was subtracting essentially from your total return, which is the third line. So you can see following the financial crisis back in 2007, 2008, you had an expectation that rates would be rising, and you can see that in 2009 they did, and 10 and 11, there was expectation that rates would rise, and they did not, and they actually fell and contributed to our total return. And then you had several years from 2012 to 18 where rates were rising, and our total returns were holding around 1-ish% for most of those years. 2013 was the year when rates really shot up and you had a negative, slightly negative total return. And I think that takes us to the new composite index and the importance of what we have done in terms of strategy changes, that we make capital investment decisions and we make decisions on this investment portfolio, particularly for these long-term reserves, from a long-term basis. And the rationale for extending duration wasn't to try to time the market. It was just merely to take a longer-term approach to monies that are very long-term. Those reserves will, based on the structure of our indenture, they're likely to always be necessary to maintain the AA credit ratings. So rather than having a very short-term view on investments, we've taken a long-term approach for the M&O reserve, and we may do that eventually for the general account. And you can see in that lower index, you have a lot higher returns than the shorter index, but you also have more significant volatility of those returns. And so if we turn to slide 7, I'm going to turn it back over to Clayton, but then I'll touch on that when we get to slide 9 about the volatility in the M&O reserve. So Clayton, could you cover 7 and 8?
Certainly. So on slide 7, I look at this and I see, 3 or 4 things, but I think notably is, first is the strong returns this time last year, first quarter of last year, both for the portfolio and for the benchmark, as rates dropped with the pandemic coming on in force. So very strong returns. The second thing I see is a little bit of underperformance for the portfolio during that period, as risk-free treasury rates rallied stronger than some of the other things that the portfolio is invested in, such as municipals and other things. And then finally, on this slide, I see much lower returns, certainly for the last 9 months of the calendar year. And as Alan has highlighted during past meetings, this is absolutely to be expected going forward. We do expect very modest returns, and even if interest rates do increase, as could easily be the case, like they have the past couple of months, we may see some negative performance, such as we saw in October. Moving on to slide 8, we see the performance for the general account, the unrestricted general account, with the balance of $302 million. The performance is reflected here as well in the first 2 columns there under portfolio and benchmark, and then further out in the 5th and 6th columns, we see the target duration for the portfolio as well as the average duration. And we're running typically very tight to the index on a risk adjusted or risk basis, which is in one sense measured by duration. And then I'll turn it back to Alan for slide 9.
Great, thank you. On slide 9, what you're looking for on that previous chart that Clayton covered is you want to see the portfolio's return relatively in line with the benchmark index. We've accepted a similar amount of price volatility risk in terms of duration. We have similar high quality securities, so that's what you're looking for. For the M&O reserve, because we're now in the midst of a transition period, it's a little harder to view, and I apologize for the complexity of this table, next 2 tables, but it's a little unavoidable during this transition period. What you see in this bar chart is the two indices now and the portfolio. And so if you focus just in on the January, February, and March period, what you see is the portfolio in blue and the return versus our old index in red or orange. And you'll see that they're fairly close. So that's the same that you saw with the general account and the same benchmark. And what we've layered in now is this new benchmark. And you can see that earlier in 2020, when the pandemic was hitting and rates were falling, you have positive returns. And going back to the previous slide, you can see that some of those returns are associated with price return, and some of it is associated with the income. And so clearly, when you get these big spikes in returns, a lot of that is price appreciation because rates have fallen. And so you can see how we would have done in this new longer benchmark index. It had very large returns when rates were falling. And then you see rates bottom out in the near term 9 months and begin to rise. So that's why in April, May, and June, you've got very low returns. And then in August, you start to see some negative returns for the longer term benchmark. Longer term rates are rising and the yield curve is steepening. So the differential between short and long rates is increasing. And so again, this is to be expected, and that's what we will see in years coming, that you'll see greater return volatility of the portfolio. But near term, you're going to see particularly a mismatch between the portfolio's returns and the index. So we're not going to return exactly like the old index, and we won't return like the new index. We'll be somewhere perhaps in between, but it really depends on how much interest rates rise or fall near term. If you move to slide 10, the top line of that table shows you the portfolio's trailing 12-month return. So for the portfolio, and it's highlighted in yellow, 4.45 was similar to the benchmark index at 4.79. We tended to be a little bit short the benchmark, meaning taking less rate risk, and that's primarily the reason why the portfolio was slightly below the benchmark. And again, this is the M&O reserve, approximately 50 million. The other highlighted yellow numbers in the monthly area below, those are the monthly returns versus the old index. And then for the very last month, you can see down in December, we've highlighted that we're now looking at both the new benchmark and the old benchmark. And you can see for the month of December, the portfolio returned 18 basis points. The new benchmark was negative 29. That's because of rising interest rates and falling bond prices. And the old benchmark's at 17. So because the portfolio is still very short, you can see that in over to the right, in the second to right sort of sections, there's a duration for the portfolio at 2.97, which is very close to the old benchmark. We've only extended very slightly. The new benchmark target is approximately 7. So we've got a long way to go until we can extend out that far. But again, we're not in a great deal of hurry because rates are headed up currently, but we're making some progress there. And that takes us to the next slide, and I'll turn it back to Clayton.
Thank you. So are there any questions at this point? Okay, so slide 11, we show the maturity distribution, significant weight to the front end, the 0 to 1 year portion of the maturity buckets. And that's due to some of the short-term nature of the holdings in the portfolios. In other words, this chart and table reflect allocations not just to general and M&O accounts. As Alan has mentioned, as of December, we had one position going out 5 to 10 years. and a taxable muni bond, and that's reflected in the table, the second column there at the bottom. And so we would expect to see that number gradually increase over time as we do find and take advantage of opportunities. On slide 12, we show the compliance report, and of note, as we've done for performance, we've added a line there in the top section of the report, isolating unrestricted general and unrestricted M&O, given the differences in policy limits and compliance. And we're measuring that real time on a settlement date basis. Moving on to slide 13 is a continuation of the compliance report. You'll see that new position that goes out past the 5-year maturity is Boston. It's the second line item, and that was a great opportunity for us, and we took advantage of it. At the very bottom, you will note our statement regarding compliance with respect to the investment policy. And for the period ending December 31st, 2020, we were within compliance and had no issues or instances of non-compliance. For supplemental reference, I don't know, Alan, if you'd like to add anything as it relates to this slide.
I guess just for slide 14, this is really for the board and the finance committee's reference to describe all of the accounts and the policy limitations, and also the limitations within the trust agreement or bond indenture. And then in the far right column, what the strategy is based on those limitations and the balances in those various types of accounts. And then for slide 15 is also a reference slide. This shows you our trading activity for the trailing 12-month period. All of our trades are done on a competitive basis, except for on occasion, some new issue municipal securities or secondary market securities where you can't have competition. What you see is that this has been a phenomenon for several years, is that Wells Fargo just dominates the short agency trading space, both when, selling bonds and buying bonds back in. They're just very, very competitive. And this is, the same experience from peer agencies, and what we've learned from PFM and other advisors is that they just dominate that area. So for several years, we've had Wells Fargo at, the top, and they're winning about, a third almost of all the purchases and sales that we do. So, just the agency space and treasury space is incredibly competitive with very narrow bid offer spreads. So sort of to be expected that the cost of trading is very low when buying and selling, but some firms have just really made it a focus to try to be the most competitive in that space, and Wells Fargo has been in recent years. And the last two slides are just, we've left these in here for reference. One is about this matched funding versus total return and which accounts it applies to. And then the fact that on a relative value basis, that benchmark indices that we use are either all agency or all treasury indices. And we have other types of investments within our portfolios, including supranationals and municipals and corporate CP. And the rationale for buying those other, high quality securities is just relative value, trying to pick up some additional yield. So I think that concludes our presentation, and we're happy to answer any questions.
Member Von Paris, I wanted to refer you back to slide 15. You can.
I can't I can't hear you, Deb. It's a lot of background noise or something.
Okay, let's try again. So I'll refer you back to slide 14. When we've talked about traffic and revenue before, and we've had a lot of conversations about where we are from a revenue perspective. I also asked where are we from a cash balance, because that's something else that we closely monitor is our cash flows. And so when you look at this slide, the general, the M&O, and the capital, that's our unrestricted accounts. That's the accounts that we keep above 350. And you can see that we're about $120 million above our policy level. And then the operating checking account, that $50 million, that's considered restricted, but that's money that's available to us that we have moved. Either we have moved to cover checks or haven't moved into down the waterfall yet. It could go either way. So that's money also available. And then there is some bond proceeds still left. You can see the bond sub-account. So just wanted to highlight cash balances for you. It's something that we've talked about before about cash flow, where do we stand? And I think this slide does a nice job showing our cash position.
Thank you. Any questions from any members?
Alan, so now that we've started the phase in of the new strategy, how long do you anticipate that's going to take, or is there not an established time frame on that?
I think, Clayton and I have talked about the speed and the time frame, and normally I'm not really a market timer at all. I consider myself, particularly for these types of portfolios, relatively passive. And we talked about, as an investment committee, whether we should just, literally in a week, sell 2/3 of the portfolio and extend it out to the new benchmark, or, it's sort of a little bit of a frightening time in terms of, rates are headed higher. We're potentially coming out of the pandemic, the curve steepening. Is there any reason to, rush? And I mean, generally, I'd say not very much in favor of trying to time the market, but in this case, we're coming off of, record low interest rates, and clearly they're headed up. So I don't feel any sense of urgency to extend duration. So, Clayton and I have been looking for particularly new issue taxable munis that have been cheap relative to agencies. So we had bought one in December and another one in January, and we'll continue to look for that. And unfortunately, I wish I had some, magic answer. I think that some signals we're looking for is some return to a normal economy and some kind of new equilibrium around interest rates, and that might give us some comfort to just extend the rest of the portfolio out and get to the new benchmark duration target. So I don't know if that's going to take 4 or 5 months, or if that's more like 8 months, but I think we're working toward it, and maybe we'll have some bigger steps that we take in coming months. We had picked up some maturities and extended those out. They were kind of easy steps to take, and we're at a point now where we don't have any near-term maturities, and so we're looking to potentially swap out of an agency by selling it and buy into something that's a bit longer.
Thank you.
Okay. Anyone else? All right. Alan and Clayton, thank you very much for your presentation. Thank you also for the good work you do for MDTA.
Thank you.
So we will move on to next agenda item. Item number 3, the second quarter budget comparison for the operating budget. And Jeffrey Brown will make a presentation on that. Good morning, Jeffrey. Welcome.
Good morning, everybody. Good morning. I'm assuming everybody can see me. For the record, my name's Jeff Brown. I am the budget director for the MDTA. I'm here to provide a status update of the year-to-date spend versus budget as of December 31st, 2020. To begin, as of December 31st, we had spent 40% of the budget, which was in relation to a target of 46%, which equates to $18.9 million below budget. Except for salaries and wages, objects 1 and 2, and additional equipment, which is object 11, all other objects were below the targeted spending levels by more than 5%. There were 3 main drivers for this performance. Number 1, COVID-19, reduced activity, increased teleworking, cashless tolling, things of that nature. Timing and seasonality of expenses. In many cases, some expenses typically occur later in the year, and at least until December, there was a mild winter up to that point. So those 3 things came together to provide or result in a reduced or deferred expenditures year to date. Going into a little bit more detail, for communications, object 3, we had spent at 18% to budget. The driver for this was the statewide radio system invoice, which we haven't received yet, which is worth $1.5 million. Excluding this, the rest of the object was closer to budget at a 39%. Travel, object 4, was at 2% to budget. We had an increase in teleworking and telelearning, plus there was postponement of in-person conferences and things of that nature. And typically there is a little bit heavier spend towards the end of the year in this object as well, but those things conspired to reduce expenditures. Fuel and utilities, object 6, was at 30% spend. Again, COVID, you had increases due to COVID for teleworking. There's cashless tolling, there's fewer toll collectors. This plus a mild winter coupled together to reduce our electrical and fuel needs at physical locations. Motor vehicle operations and maintenance, object 7, is at a 34% spend. Again, COVID reduced a lot of vehicle usage. There's more headcount vacancies, less overtime, more working from home. Plus the winter plowing season had not occurred to that point yet. So those things drove down expenses. Contractual services, object 8, are below budget at a 37% spend. The key variances within this object are advertising, which is at 15%. That's due to the 3G delay, as well as some seasonality of expenses, some summer campaign expenses that typically occur later in the year. Engineers were at 20% or 21% spend. Again, seasonality, we typically have heavier expenses in the latter half of the year. We have a lot of subcontractors where the invoicing typically lags a little bit. And then there was a lot more capital work on things like all electronic tolling and things of that nature. Janitorial expense was just slightly below budget at a 40% spend. This is mainly driven by the Francis Scott Key Bridge, where we had shut down some buildings for construction, and this drove some of the services lower. Training was at a 33% spend. Again, COVID restricted, postponed, or delayed a lot of the training. We expect some of that to come back probably in the 3rd and 4th quarter. Security services was at a 24% spend. First requests are usually dictated by building usage, which was down. So you have things like security doors and locks and things like that not occurring as frequently. Fiscal services was at a 38% spend. Easy Pass fees are down due to COVID. Plus we have less credit card fees due to the delay in the NOTDs. Finally, other contractual service was at a 23% spend. It's driven by some indirect cost for the Maryland State Police, which has only been billed through September to this point. Moving on to object 9, which is supplies and materials, it was at a 37% spend. The key variances within this one were the roadway maintenance materials, which was at 40%, which is just slightly below budget. Again, COVID reduced traffic volume and maintenance, plus there's typically heavier spending in the spring on this. Salt was at 18%, and that seems pretty straightforward. At least through December 31st, it was mild. It was a mild winter, not much snow, but obviously with the last month, this may change going forward. Easy Pass transponders was at a 33% spend. Excuse me, we're still using some pre-existing inventory. However, a new order has arrived, but it's not reflected in these numbers as of yet. So we expect to track closer to the budget for the remainder of the year. Plus, this was a reduced line item in the full year amended budget. Replacement equipment was at 25%. There's some pending equipment purchases that have not been, that will be ordered later in the year. Finally, additional equipment, object 11. This was the one that was above budget. This is due to HR scanners that were expected to be expensed last year, but they were actually purchased and paid for in this budget year. So that's what's driving that variance. Without those scanners, we'd be tracking at a 25% spend. Finally, fixed objects was at, which is object 13, was at 24%. Essentially, time insurance payments, which are typically lumpy, come in throughout the year. Some of the big ones have not occurred yet, which is driving that lower. So we expect some of that actually to come back towards the end of the year. That concludes my presentation at this point. Be happy to take any questions at this time.
Member Ardinger, I did have a question. With some of the actual versus budget, I know some will be a timing difference, but you had indicated that COVID had an impact. Any feel on what you think overall will be at the end, a decrease from the budget?
I couldn't say, exact numbers. Certainly, I would think we'd be a little bit down. I mean, things that COVID's affected are maintenance. Obviously, the vacancies, the hiring freeze has had a big impact. That keeps us lower. That ripples through other things such as, overtime. Overtime and just maintenance work and cashless tolling. All those things will reduce over time. How much? I don't know. Certainly some of it will come back as well, right? I mean, if we start coming out of the pandemic, some of the training and in-conference and the travel, you would expect maintenance to come back up as well. But I couldn't tell you how much at this point. I really don't have a good feel for an exact number at this point, but there's obviously a couple of things that are kind of going back and forth with the COVID.
Thank you.
Any other questions? Okay. Jeff, thank you very much for your presentation.
Okay, thank you.
And talk to you soon. Thanks. Okay, we will move on to the next agenda item, and that'll be the second quarter budget comparison, capital budget. Jeannie Marriott. Hi, Jeannie. Welcome.
Hi. Good morning. For the record, I'm Jeannie Marriott, the Capital Program Manager. I'm here to provide an update of the fiscal year 21 capital spending as compared to the budget in the draft CTP. This information will also be presented at the board meeting on February 25th. Through December 31st, 2020, the capital spending was $165.2 million. This is 30% of the budget of $543.3 million. 31 of the 105 projects budgeted in fiscal year 21 were within the acceptable spending limits of 25 to 75%, which is plus or minus 25% of the 50% target. Now, if you would please go to attachment A. These are the 7 projects that are budgeted for more than $10 million each in fiscal year 21. We see that the Nice Middleton Bridge replacement is at 28%. The I-895 project is at 42%. Replacing the 5 kilovolt feeder on the Bay Bridge is at 11%. The 3G project is at 15%. Rehabilitating the Fort McHenry Tunnel vent fans is at 29%. And deck rehab and miscellaneous modifications to the westbound span of the Bay Bridge is at 37%. And part of the ETL Northern Extension, I-95 improvements between Maryland 152 and Maryland 24 is at 25%. So the total spent for these 7 projects through the first half of fiscal year 21 is $96.4 million. And the spend rate for these 7 projects is 29%. And the amount spent on these projects is 58% of the overall capital program spending of $165.2 million. And I would be happy to answer any questions you may have.
Any questions? Any members? Okay.
Member Von Paris, I just would like to add one point. When working with OEC, we have just all of our budgets, whether it's capital or operating, stress that with COVID and with the transition to 3G, that this is not a year that we could ever overspend any of our budgets. And, in prior years when OECs had a target of 100%, spending 100% of the capital budget, in order to have a target of 100%, you have to be in a place not only to be able to underspend the budget, but also be able to overspend the budget, to be able to cover it if you're 10% short or 10% over. So because we've asked that they make sure that there is no overspending of the capital budget, their target level has to be lower than 100% for risk. Otherwise, there'd be an increased risk of overspending the budget. So when we get closer to the end of the year and their spending comes in at something less than 100%, that's what we've asked them to do. And so I mention it now just before we get to the end of the year. So to be fair to them, that they should not be judged on spending 100% of the budget this fiscal year.
I agree with your position on that, on the overspend. I think it's very important, and I think it's important that it's communicated all the way down the line.
Thank you.
Okay, any other questions? Okay, if not, we will move on to the Janie, thank you very much. I want to thank you. And we'll move on to the last item number 5 on the agenda. Cheryl Lewis-Orr is here. Hi, Cheryl. How are you?
Good morning.
And
fine,
Deb,
thank you. How are you?
Fine, thank
Good
you.
morning.
And Deb Sharpless will also be sharing some information here, the quarterly update on traffic and revenue. And I guess we will, at this point, turn it to you, Cheryl.
Okay. All right. Good morning. For the record, my name is Cheryl Lewis-Orr, Director of Revenue for MDTA. And this morning, I, along with Deb Sharpless, will be updating you on the second quarter and fiscal year-to-date traffic and revenue results for fiscal year 21. And I'd like to first note that within the context of this update, transactions refer to paid transactions and not actual revenue. Traffic volumes have been in line with estimated volumes, and Deb will provide more detailed information on the traffic and collected revenue. System-wide, for the period ended December 31st, 2020, transactions were below the same period last year by 42.4 million, and revenue was down $135.8 million. Approximately 106.1 million of this decrease was expected due to the impact of the COVID-19 pandemic and was reflected in the traffic and revenue forecast. Collected revenue was $29.5 million below forecast, and transactions were approximately 14.7 million below forecast. The collection of revenue and achieving the forecasted results have been directly impacted by the delay in the 3G electronic toll collection system. The attached second quarter traffic and revenue update report prepared by CDM Smith shows the breakdown of transactions and revenue by the legacy ICC and ETL facilities for the period fiscal year 21, second quarter and year to date. So I'd like to take your attention to page 13, beginning with table 4. And you will see that total transactions on the legacy facility for the second quarter were 10.2 million below the second quarter forecast. Easy Pass transactions or ETC revenues were down $6.2 million for the second quarter, while video transactions were up by 557,000. Year-to-date transactions were down 23.3 million, lower than the same period last year. ETC transactions were 12.7 million lower, and video transactions were $229,000 higher. That ramp up in video transactions during the second quarter was likely due to the courtesy letters that were mailed to our customers in September and the return to mailing video invoices in October, as well as the increase in overall video transactions due to being cashless since mid-March of 2020. If we move on to table 5 on page 15, we see that the corresponding revenue for the second quarter of FY21 was 40.9 million lower compared to the second quarter of FY 2020, with ETC revenue being down 21 million and video revenue increasing by 4.6 million. As of December 31st, 2020, year-to-date collected revenue was 99.9 million less compared to the same period last year, with ETC revenue being down $44.5 million. Video toll revenue increased 1.7 million for the year compared to the same period last year. And as mentioned above, the increase in collected revenue is likely attributable to courtesy letters being mailed to the customers in September and the resumption of mailing video invoices in October. Table 6 on page 16 show the intercounty connector trips for the second quarter and year to date. And we see that our second quarter transactions were down 8.1 million or 92.1% compared to the same period last year. And year-to-date transactions were down 16.7% or 91% compared to last year. On page 7, we have the corresponding revenue. Page 17, table 7, we have the corresponding revenue, which is 93.2% or 16 million down compared to last year during the second quarter. And year-to-date revenue was down 32.7% or 92.3% compared to last year. The delay in transitioning to 3G has impacted the collection of revenue, and the COVID-19 pandemic has also contributed to our decline. ETL transaction and revenue are shown on page 18 in tables 8 and 9. And for the second quarter, our fiscal year 21 transactions were 1.3 million below the second quarter of FY20. And year-to-date transactions were 2.5 million below the same period last year. Second quarter ETL revenue, which is table 9, was 1.6 million below the same period last year, and year-to-date revenue was 3.2 million below the same period. Table 10 on page 22 shows forecasted versus actual results. You'll see that legacy transactions for the second quarter of FY21 were 2.4 million below forecast, with ETC transactions being 3 million below forecast, and video transactions were 592,000 above forecast. Year-to-date transactions were 4.3 million below forecast, and ETC transactions fell 5.1 million below forecast. Video transactions exceeded forecast. Yes.
Will you just pause here for 1 second? I just want to make, Cheryl, do you mind muting for a sec? There, perfect. Thank you. Wanted to make a point here because I'm recognizing that sometimes there's a point of confusion here. And because we're starting to use different terminologies. We're using traffic, transactions, and revenue. And so in this report mirrors the information that I presented to the board in January. It's through the same time period. It's through December. I was just a little bit ahead of this report coming out. The numbers that I reported in January align exactly with this. Earlier in this report, it's the same graphs that I had shown you in January, where we talk about traffic aligning with the forecast. But then when we get down here and Cheryl's talking about transactions in relation to the forecast, we're behind. And that's because traffic and transactions are different for us this year. In the past, they used to be the same, but transactions are paid. And I know Cheryl said that in the beginning of her remarks, but you know, we're talking about like starting on this table where transactions are under the forecast, and that's because of the transactions that haven't been processed. So these transactions are being referred to as processed and paid transactions, whereas traffic is just that. It's the raw data of the vehicles that are on the roadway. So as she continues on and she's talking about transactions in the forecast, I wanted to make sure I made that distinction just to make sure there's no confusions and you know that there's not the thought that there's any contradiction of what is being said. In this context, transactions and traffic are different. Cheryl, sorry to interrupt you, but it's just trying to help for clarification here.
Okay, thank you. So I think I was video transactions exceeded forecast by 772,000 in the forecast for legacy facilities. On page 11, we have the corresponding revenue. And on table 11, that's on page 24. And legacy facility revenue is 4.3 million below forecast for the second quarter of FY21. And with ETC revenue being 10.3 million below forecast, while video revenue was 6 million above forecast. As of December 31st, year-to-date revenue was 11.3 million below forecast. ETC or Easy Pass revenue was 18.8 million below forecast, while video revenue was 7.5 million above forecast. And as mentioned above, the increase in collected video toll revenue was likely attributable to courtesy letters and the resumption of mailing video invoices in October. Also, due to the hold in video invoicing, CDM Smith forecasted that no video revenue would be processed in July and August, and some video would be collected again beginning in September. And you can see that for July and August, there was no forecasted video revenue. In table 12, we have the ICC forecasted versus actual results. And during the second quarter, of FY21, ICC trips were 5.1 million or 87.8% lower compared to the second quarter of FY 2020. Year-to-date trips were 85.7% or 9.9 million lower. ETC trips were 94.4% or 10.8 million below forecast, while video trips were 970.5% or 900,000 above forecast. Again, CDM Smith held. Due to the hold in the video transactions, CDM Smith forecasted no video transactions for July and August, with a little revenue returning in September. Also, due to delays in trip construction, nearly all trips from travel occurring in FY21 have not yet been processed. Video trips processed so far in FY21 are mostly associated with travel that occurred in FY20. So on page 26, this is the ETL comparison of forecasted versus actual. And for the second quarter of FY21, transactions were 313,000 lower than the same period last year. And year to date, transactions were $566,000 lower compared to FY20. Due to the high volume of ETC transactions on the ETL, we do not show video tolls separately. Revenue for the second quarter of FY21 was $317,000 less than FY20, and year to date, revenue was $600,000 lower than the same period last year. And this concludes my portion of the update, and unless there are any questions, I'll turn the presentation over to Deb Sharpless for details surrounding the actual transactions and revenue.
Sure, thank you.
You're welcome.
I actually don't have anything else to add. I thought Cheryl walked through each one of the tables that we went through. So CDM Smith, they produced this quarterly report for you, and it aligns exactly with the conversation that we had in January. So I'll just stop and see if there's any questions or anything you'd like us to talk about in greater detail.
Any questions from any members?
This is Member Ardinger. Deb and Cheryl, thank you for this update. And I might be simplifying this too much for my own purposes, but the distinction between traffic versus transaction. Traffic, is my understanding correctly that when we see the decrease in traffic, we pretty much can say this is due to COVID. But when we see the decrease in transaction, it's a combination of the 3G and the COVID. Can we make that clarification?
I wouldn't phrase it that way.
You want to go ahead?
Sure.
Okay.
Sure. Let me look on the report real fast. Let me see if I can point to something directly.
Well, there's a chart on page 27 that shows the forecasted traffic. That might be helpful.
Hey, Deb, part of that
Yeah.
answer would be the pause in NOTDs. That would be part of the answer.
Yeah.
And that would be showing in transaction.
Right. And so traffic, when CDM Smith builds their forecast, they have the economic factors. So that's one piece of information that they have, and other recessions and just historical. Then they start with our prior year or 2 years before traffic, and then they layer on top of that COVID. And so when they layered on top of COVID, our traffic is where we predicted for from a COVID perspective. Then when they got to the forecast piece for transactions, they layered on top of that assumptions about 3G. So the delay in mailing notices. That's why no revenue was forecasted in July, August, September for video tolls. So the traffic piece is where it was forecasted to be because of COVID. So the transactions being behind forecast is because of 3G.
Thank you.
Deb, does, I have just a quick question here. CDM Smith, they're forecasting in terms of the impact of COVID going forward with the teleworking and patterns and so forth. Is that changed from at all since they first presented it to us months ago? Has there been any kind of different formula used or projection made on that going forward, you know?
I would say yes, but I gotta really qualify that because I'm going back in time. So when around October every year, we do a financial forecast. So when, get my date straight. So October of 19, November 19, that time period, pre-COVID, we had our traffic and revenue forecast. Then the forecast was updated in June because of COVID, and we saw a shift down in our revenue and transactions because of COVID. When they produced this forecast, this October of 20 forecast, transactions and revenue shifted down again. That additional shift above where we were for COVID was a combination of going to AET, transitioning to 3G, the cash rate for video toll customers, the delay in mailing notice. So if we've had these shifts in our forecast, but I'm starting all the way back to pre-COVID, then COVID, then the customer-focused decisions that were made with processing transactions as well as 3G. So the forecast today that was issued the very end of October incorporates COVID as well as what we knew at that time about transition.
Okay, thank you. Can I, since we're talking revenue and we touched on two revenue streams, well, three, as we said, COVID and the 3G and then the backlog. Is it safe to say that we're making progress with the backlog and 3G? I know there's a lot of effort being put forth there.
Yeah. Yeah, I mean, we are making progress in the sense that the volume of image transactions that Conduit is currently reviewing, their monthly average is higher than what the average was for the prior year. So from that respect, we're making progress. We're continuing to keep ETC transactions that are e-tolls, that's transponder based. We're continuing to keep them current for all of the facilities except for the ICC. And we've been actively working on plans and models to address the backlog once we transition. So I think there is progress being made. We'll update the numbers for for January very shortly, and then be able to measure where we were compared to the end of December.
Thank you. Are there any other questions? Okay. Deb, that's all you have on the report at this point? Does that complete your report, your update?
Yes, that completes the traffic and revenue update.
Thank you. Okay, well, that we've gone through the entire agenda. Nothing further on the agenda. In that case, is there a motion to adjourn?
So moved, Member Carroll.
Okay, second.
Member Ardinger, second.
Okay, we have a motion and a second. All those in favor?
Aye.
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 Okay, thank you. We stand adjourned. Thank you very much.